I thank the chairman for yielding. Yesterday was an important day because it was the day the FOMC met and the markets were hanging in there, finding out what will be said, at 2:15. And practically they were looking for two words, whether or not two words would exist: extended period, whether this process will continue for an extended period. And this, to me, demonstrates really the power and the control that a few people have over the entire economy. The economy, virtually the markets stand still, and then immediately after the announcement, billions of dollars can be shifted, some lost and some profits made. But it's a system that I think doesn't have anything to do with the free market capitalism. It has to do with a managed economy and central economic planning. It's a form of price fixing. Interest rates fixed by the Federal Reserve is price fixing, and it should have no part of a free market economy. It's the creation of credit and causing people to make mistakes. And also, it facilitates the deficits here. Congress really doesn't want to challenge the Fed because they spend a lot. And without the Fed, interest rates would be very, very much higher. So to me, it's a threat to those of us who believe in personal liberty and limited government. And hardly does the process help the average person. Unemployment rates stay up at 20%. The little guy can't get a loan, and yet Wall Street is doing quite well. But ultimately, with all this power, the Fed still is limited. It's limited by the marketplace. They can inflate like crazy. They can have financial bubbles. They can have housing bubbles. But eventually the market says it's too big and it has to be corrected. The mistakes have been made. So they come in and the market demands deflation. Of course, Congress and the Fed does everything conceivable to maintain these bubbles. But it also it's out of control of the Fed once the change of attitude comes, when that inflated money supply decides to go into the market, then prices are going up. Once again, the Fed will have difficulty handling that. The inflationary expectations and the velocity of money are subjectively determined. No matter how objective you are about money supply and conditions and computers, you can't predict that. So we don't know what tomorrow will bring or next year. All we know is that the engine is there, the machine is there, the high-powered money is there, and of course we will have to face up to that someday. The monetary system is what breeds the risky behavior, and that's what we're dealing with. Today we're going to be talking about how we regulate this risky behavior. But you can't touch that unless we deal with the subject of the risky behavior comes from easy money, easy credit, artificially low interest rates, and the established principle from 1913 on that the Federal Reserve is there to be the lender of last resort. And as long as the lender of last resort is there, all the regulations in the world won't touch it and solve that problem. And I yield back.
Thank you, gentlemen. The gentleman from Texas, Mr. Paul, the ranking member of the subcommittee.
Thank you, Mr. Chairman. I have a question for Chairman Bernanke. During the early part of the decade, a lot of the free market economists would keep saying, well, interest rates are too low, too long, and there was a financial bubble and a housing bubble, and there had to be a correction. And, of course, we did in 2008. Since 2008, many of the mainstream economists have more or less agreed with that assessment because frequently we'll hear them say interest rates were held too low, too long. And I think even Secretary Geithner had made that statement. Where do you come down on that perception? Do you think interest rates were held too low, too long?
Well, Congressman, I've given a speech on this, and I think the bottom line is that nobody really knows for sure, but that the evidence is really quite mixed. And I would say that even if they were too low for too long, the magnitude of the error was not big enough to account for the huge crisis we had. I think what caused the crisis was the failures of regulation. And I would fault the Fed here, too, because some of those failures were ours in the sense that we didn't do enough, and I've admitted this and acknowledged this many times, we didn't do enough on mortgage regulation. So I think it was the weakness of the regulatory system, not monetary policy, that was most important here.
Of course, I don't agree with that, but if you assume for a minute that it was too low, too long, and you had perfect regulations, what is the harm done by interest rates being too low, too long? Do you see any damage by interest rates being artificially low for a long period of time? Let's just sort that away from regulations for a second.
Well, certainly one possibility, which my colleague to the left knows a lot about, is that if you keep rates too low for too long, you get inflation, and that every central banker wants to be sure that the price level remains stable, and that's an important consideration.
Do you think the investor, the businessman, makes mistakes if interest rates are lower than, say, the market? Aren't low interest rates an indication that there are savings? And if there's no savings, but the interest rates are low because of newly created credit by the Fed, does that not send a false signal to some investors and some business people?
Well, if interest rates are below their normal levels, it's because the economy is operating at a very low level. I mean, currently we're not in anything that an economist would call a Pareto optimal equilibrium or anything like that. We certainly are in a situation where a lot of people are out of work, and consumption is well below its normal levels, and low interest rates serve the function of increasing demand and putting people back to work.
But you don't think that if interest rates are 2 and 3% instead of 6%, without artificially low interest rates, there won't be a temptation for people to build too many houses, or the people to, try to capitalize on the fact that they are anticipating price inflation and participate in the bubble?
Well, Congressman, interest rates are very low right now, and I don't think building too many houses is really a problem.
And that makes the very important point. In the boom part of the cycle, low interest rates cause people to do things that might not be proper and the best for the economy. And then when the bust comes, we resort to the same policy of keeping interest rates, extremely low for too long. What are the chances? Do you think there's any chance in a year or 2 or 3 from now we'll look back and say, well, not only were they too long in the early part of the decade, that they were too low too long in the latter part of the decade, because when the prices start to go up, I mean, it's sort of, a little bit too late, then you have the job of reining that all in.
Well, it's a difficult, central banking is an art, and we need to balance our dual mandate. Our dual mandate is to maximum employment and price stability, and we need to try to find an appropriate policy that gets us as close as we can to both sides of that mandate.
See, the free market people see that the dependency on regulation is just, imaginary, because the fault is all these mistakes being made because they have false information. Price fixing, nobody's advocating wage and price controls because of all the false information. You can't run an economy with price fixing. That's why socialism fails. But if you fix the price of interest rates, there's one half of the economy because you're messing around with the monetary system. And then all of a sudden, instead of dealing with that, we say, we just need more and smarter regulations, and we're going to solve all these problems. That doesn't concern you at all?
Well, you need some system to set the money supply. I guess you're a gold standard supporter. Is that, I don't know if that's correct.
I'm for the Constitution.
Every major country, though, currently in the world uses a central bank, which must make some decision about the money supply, whether it's to keep it stable or to move it around. It's nevertheless a choice that's made.
But then there's no good information for the investor, unfortunately.